My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends just trying to make a little money. My job's not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sure, we know it. This market behaves better than it should. Yes, it held up with some real spots of strength today. Dow only gaining 26 points, S&P advancing 0.42%, NASDAQ jumping 1.23%. But the truth is, there's a lot of rot underneath. And I think many investors are in denial about how bad things can be for some of the weaker players out there, the ones actually involved with the economy, the ones that don't have bulletproof balance sheets. Consider it this weekend Warren Buffett presided over a somber annual meeting instead of the usual festival of investing. We had an older gentleman giving us some brilliant lessons, followed by a remarkable question-and-answer session with CNBC's own Becky Quick. Typically, when the market gets hammered, Buffett's the first guy to tell you to stick with it. But this time he wasn't bullish by any stretch of the imagination. I don't blame him. Late last week, I told you it was time to start doing some selling, and I still think that's the right call. We've had a big bounce from the bottom. We were selling all day today from our charitable trust after selling pretty heavily at the end of last week. I'm going to get to 20% cash. Not there yet. Got an ActionAlertsPlus.com conference call this Thursday at 11:30, and I sure didn't want to have to defend a bunch of losers like Tyson Foods, which we bought for the trust when the trade war with China ended because the Chinese had a desperate pork shortage. I always say it's better to be lucky than good, and we were not lucky. As the coronavirus took the world by storm, Tyson stock plummeted. Buffett somewhat unwittingly quoted the late, great John Maynard Keynes, saying, when the facts change, you have to change your mind. And boy, did the facts change. But we're certainly not selling everything for the trust. We're doing some buy of some things, because as you saw today, there are plenty of companies whose stocks are doing quite well here. Remember last week we came up with our Cramer COVID-19 index, which had more than 11 stocks, $11 trillion in market cap versus, say, around $25 trillion for the entire market. We're selling the stocks outside this index, so when everything gets hit, we can put the money into the stocks in this index. The differences between what's working, the Cramer COVID-19, and what's not working are incredibly stark, and you have to be blind not to notice. And by the way, this is not something that's ephemeral, okay? This is not flitting. This may be something secular and important to notice. I bring it up because Becky asked Warren whether we are in the twilight of index investing here, because so many people have embraced it already. Maybe too many people. Buffett seemed to interpret that question as a challenge to his dictum that active money managers generally can't consistently beat the averages, especially when you account for their fees. I have a lot of truth to that criticism. It's incredibly hard to beat the S&P 500, and that's also in part because the index is more actively managed than it seems. They regularly change things up, subtracting losers, adding winners. But that really wasn't the thrust of what Becky was asking. She wanted to know if index fund investing may not hold up all that well here, because the index has tons of bad stocks in it that may not survive a pandemic. You could argue that these bad stocks may come back, but I think Buffett would agree that many of them are in big trouble. That's why he dumped his huge stakes in the 4 big airlines. He's not waiting for them to bounce back. He knows they're losers in a new environment where nobody's flying, and that may not change anytime soon. To me, that was an affirmation that this works, that this is where you have to go. Buffett has a long-term horizon, sometimes say too long. He's perfectly willing to lose money in the short term if he believes there's a long-term opportunity, but he didn't do that with the airlines. That's quite telling. He acknowledged that the facts have changed, and he bailed on the whole group because he knows these stocks are toxic. Again, major part of the S&P 500, toxic. I feel the same way about whole swaths of the S&P 500, which is why Becky's question really resonated with me. Look at it this way. So far this year, 114 companies in the index have suspended guidance. 79 suspended their buybacks, and 31 have either cut or eliminated their dividends. Those are cold, hard facts, people. That's just the first quarter. We're only a couple of months into this downturn with 30 million people unemployed and maybe the worst recession since the Great Depression. Many people own stocks for their dividends. What happens when those dividends get tossed in the wood chipper? You know, let's use some examples. It's always much more crystal clear when you teach with examples. We recently had the new CEO of Western Digital on the show, David Geckler. Straight shooter. And all things considered, I think his commodity tech storage company is doing pretty well. The company has a fantastic flash memory business. I greatly admire their technology, always have. Western Digital also had a bountiful dividend. I asked Geckler about it, and he didn't exactly say it was safe, but he also didn't say it was at risk.
On the dividend, we'll have more to say about that in the future, Jim. I'm only, I think, on day 13 or 14 here.
Now, if you listened to the whole interview, you might have felt sanguine about the dividend situation, especially given the healthy demand for Western Digital's product. But then when the company reported last week, Geckler confirmed that business remains strong. Next quarter, he predicted more earnings and revenue growth. All sounded pretty darn good, right up until when he announced that Western Digital was suspending its dividend, which was yielding close to 5% at the time, was really helping some people trying to get a little fixed income. I'm not questioning his decision. It wasn't very fixed. I know moves like this are incredibly upsetting for investors. I found it very surprising we got a wholesale suspension of the payout, not just a cut. Frankly, I found it terrifying. Look, this is not Amazon, okay? Now, that would be fine if Western Digital were an outlier, but you know what? The more I listen to these quarters, it's not. We know that Weyerhaeuser, the huge timber company, has a long track record for rewarding its shareholders. They were used to come on all the time. Last year, they paid out 34 cents a share quarterly. They raised it from the year before and the year before. This quarter, Weyerhaeuser reports some really blowout numbers. I mean, big earnings beat, terrific sales. And then the company suspends its dividend. It was totally jaw-dropping. Wall Street got caught with its pants down. The first question on the call was about how they decided to suspend the dividend rather than maybe cut it a little. Listen to what CEO Devin Stockfish had to say, though. Quote, we look at this through the context of the macro environment and our market conditions. And really, as I mentioned, just an unprecedented situation in terms of what's going on with this pandemic. Broad swaths of the economy being locked down. We're seeing historic levels of unemployment, GDP contraction in Q1, expectations that it's going to be more dramatic in Q2, consumer confidence dropping, and really no clear path on the trajectory of the recovery. Ouch! Weyerhaeuser's bread and butter is housing. So this next part was a suitable epitaph for the dividend. Quote, we're expecting a significant erosion in housing and residential construction, as well as, to some extent, larger remodel activity here in the near term. I think we're in the early stages of understanding what that's going to look like. It may get worse for a while, end quote. Huh? I mean, that's it. Goodbye, dividend. Brutal. Now, I know there are plenty of standout companies that are thriving here. They're in the S&P, too. But for every Microsoft, which you know I love, or Amazon, there are the Deltas, the Boeings, the Carnivals, the Western Digitals, the Weyerhaeusers. I mean, it's just far more treacherous out there than the action might lead you to believe. And I know a lot of people are like saying, oh, Jim, why aren't you more bullish, more bullish? Look, I'm bullish on this, okay? Don't ask me bullish in the S&P 500. They're different. That's what I'm saying. They're different. I know the comeback today was sweet for the bulls, but it was in this. The big growth techs are extraordinary. They're divorced entirely from the world of Weyerhaeuser, no doubt about that. They're not linked to housing. They're divorced from Western Digital because that has a suboptimal balance sheet. These don't. There are many other companies with stocks trading like their dividends are about to go away, and you know, and I know the bottom line. If you own a lot of the Cramer COVID-19 index, boy, you saw it turn right at 931, didn't you? But if you're in the S&P 500 index fund, I'd recommend selling some of this if the strength continues. I know I still have more selling to do for my trust so I can buy more of the Cramer COVIDs. If you're in individual stocks and they can grow even in tough times, then you should be in much better shape than the index fund investors who are really stuck holding the bad with the good. Because right now, there's a lot more bad than Wall Street seems to think. Jim in Florida. Jim.
Mr. Cramer,
yes.
Thank you for being a voice of reason and reassurance in these unstable times.
Oh, thank you, man. It's been really tough. It's not been a great time. It's been a lousy time. I'm not having a good time.
Yeah. My sister had it. She's a nurse, and she's back to work already. Thank God for that.
I'm glad she's feeling better.
But my question's on C Limited. It might be a good COVID stay-at-home stock. It's a Singapore-based e-commerce and e-gaming company. Revenue growth's in the 160 range, and it's 99% institutionally owned. I got in at 17 last year. It's at 55. Do I stay with it, or is this ride done?
I do not know C Limited, sir. I think that's a very interesting stock, and I happen to like Singapore very much, but I've got to do more work, and I have to come back. It's not within my ken. Let's go to Jordan in Minnesota. Jordan.
Hey, Jim. Booyah.
Booyah,
Cool.
Jordan.
Big fan and follower. Hope you and your family are staying healthy and positive.
We're staying healthy, but we're staying separate, which is kind of, well, whatever. We're staying healthy. Thank you. Hope you are too.
Yep. And thanks for being a strong voice for small businesses. My wife's a pediatric dentist and a business practice owner.
Oh, thank you. Small businesses are still in a lot of trouble. I know that we don't trade small businesses, so it's hard to feel There's a divorce between what we trade and what's happening out there, and you and I both know it. How can I help?
I got Dell Technologies. I'm a young and long investor. Bought a few years back at $40 a share, rode up to 70, and then back down to 40. Earnings at the end of the month and a weaker balance sheet showing more liabilities than those assets. Should I be looking to buy more, hold, or sell when I get the chance?
I believe in Michael Dell. I totally understand that it's not the great time to be in that particular stock because of the balance sheet, but sometimes you have to believe in a guy. And look, I could be wrong. Michael Dell's like anybody else; he's human. But I think that he's going to be able to come through this. I really do. Let's go to Justin in Kentucky, please. Justin.
Hey, Jim, what do you think of eBay? The company had
I didn't like that quarter.
Last week.
I didn't like that quarter. I mean, shouldn't they be doing great? I mean, it really is incredible that all these companies that are internet companies that should be doing well, and the only ones that really ended up doing well were Facebook, Amazon, and Alphabet. Alphabet's such a buy here. I don't know what the deal is. All right, anyway, I know today's comeback story was sweet for the Bulls, but you've got to understand there's some rot underneath it, just not in the big cap names. Remain cautious, big cap COVID names. Well, maybe tonight. How should companies start thinking about reopening during the coronavirus era? Salesforce CEO Mark Benioff seems to have an idea. Then Warren Buffett's investment actions speak louder than his words. I'll tell you my key takeaways from Berkshire Hathaway's annual shareholder meeting. And the company helping J&J expand manufacturing for potential coronavirus vaccine. You don't want to miss that. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.